All right, we're looking at the Mandarin Incorporated case study now. Let's scroll down and read the first question. Based on Fletcher's estimates, the amount of joint venture operating income in millions included on Mandarin's consolidated 2015 financial statements should be 282, 0, or 141. So it looks like we're going to have some type of joint venture that Mandarin is involved in, and then we need to determine what the operating income is going to be on their income statement, on Mandarin's income statement. Mandarin operates a chain of 5-star hotels throughout the UK and the US. Over the last couple of years, the company has embraced an aggressive expansion strategy that has culminated in the acquisition of several high-profile hotels. Its largest acquisition, that of World Cuisines, was made in 2000 under the Uniting of Interest method. Mandarin complies with US GAAP while preparing its financial statements. After lengthy negotiations, Mandarin has decided to form a 50-50 joint venture with Best Foods Incorporated, under which the companies will share control of several hotels in the Las Vegas Strip. Mandarin intends to employ the equity method, that's important here, to account for the joint venture. Best Foods complies with IFRS and will use the proportionate consolidation method to account for the venture. John Fletcher is an equity analyst who has covered both companies for more than 5 years. He has estimated the joint venture's financial information for 2015 to prepare his estimates of each company's earnings and financial performance. This information is presented in Exhibit 1 below. So we've got our expected operating income of 282, which is what we need to know for that question. We need to know that joint venture operating income and then what's going to show on Mandarin's financial statements. So I highlighted the equity method up here. So essentially, by using the equity method, we're kind of accounting for this venture as an investment, not necessarily a subsidiary or an operating company that Mandarin owns. So any operating income that is made through the joint venture is going to flow through to Mandarin's income statement and just show up in net profit. It's not going to show as its own line item under operating income. So essentially, this is tricky, but basically it ends up being B0 because we're not going to have a line-by-line breakdown of that operating income for this joint venture. Answer B. Question 2. Based on Exhibit 2, calculate the value of PP&E net on the consolidated balance sheet under both IFRS and US GAAP in millions. So A, we've got IFRS different from GAAP. They're the same in answer B, and they're also the same in answer C. So let's scroll up and read till we get to Exhibit 2. We left off at Exhibit 1, so let's start reading here. On January 1st, 2017, Mandarin acquired 80% of the outstanding shares of Seafoods in exchange for Mandarin's no common stock with a fair value of $828,000. The fair value of the subsidiary shares on the date of the exchange was $920,000. Below is the selected financial information from the two companies immediately before the exchange of shares and recording of the acquisition. All right, so we've got the Mandarin balance sheet information here. So we've got cash, inventory, PP&E, which is what the question is asking about. And then we've got Seafoods book value, and then we also have Seafoods fair value. So a few things at play here. So we've got to determine what they would owe under IFRS and GAAP, and whether those two standards have different policies in this scenario. And then we basically need to determine whether we're going to be using book value or fair value to report this. Another thing at play, I guess, is that 80%. So starting with that 80%, for both IFRS and GAAP, as long as the parent company has control over the subsidiary, which basically means anything over 50%, so 51% to 100% control, they include 100% of the subsidiary's assets and liabilities on the balance sheet. So we're basically going to be adding this 1081 number to either the book value or the fair value. And so then the other part that you need to basically remember is that it's going to be held at fair value. So when we do that, we basically just have to add those two numbers together. We add the 1081 to the 630,000, gives us 1711. Answer C. Question 3. Based on Exhibit 2, the value of goodwill and the value of non-controlling interest at the acquisition date in millions under the full goodwill method are closest to. All right, so we're going to need to make two calculations here based on the balance sheet data for goodwill and non-controlling interest. So we already know that we acquired 80%, so the non-controlling interest will be 20%. And then that's going to come into play for the non-controlling interest. And to basically calculate the non-controlling interest, this will be pretty straightforward. So it's just going to be what we acquired the company for and then multiplied by the 0.2%. So it'll just be 920,000 times 0.2, which is what we do not control. That'll be our non-controlling interest. For the goodwill is going to be the difference between what we paid, 920, and our net assets, 653. So it's basically the premium that you're paying for the actual assets on the balance sheet, since that needs to kind of be accounted for somewhere. So when we do that, we'll bring in this for our answer. So we have 920 minus 653, giving us goodwill of 267. See those two numbers right there. And then we're going to be doing that 920 purchase price times 0.2, which is what we don't control the company, giving us 184. So we can see 267, 184 corresponds with answer B. Question 4. At the end of 2013, Best Foods reported investment in Meat and Grill as 1 million, a little over a million, or 0.93 million. So let's read this last sentence here. On January 1st, 2013, Best Foods acquired 40% of the shares in Meat and Grill for $1 million. During the year, Meat and Grill earned $100,000 and paid dividends of $30,000. So we need to determine what our reported investment in Meat Grill is worth. So essentially, we acquired 40% of the shares for $1 million. So that's our starting point, $1 million. And then during the year, the company earned $100,000, and we have a 40% claim on those $100,000 of earnings. And we paid dividends of $30,000. So dividends come out before we're gonna be paid our share. So this $100,000 is going to go to $70,000 before we get our share. So we can pull that in with reporting our investment. So we'll have our 1 million, and then we're going to add 40% of 100,000 minus 30,000, brings us to 1028, which is in line with answer B there.